Bitcoin is now much easier for investors to buy and sell because there's now well-regulated exchange-traded funds, ETFs, in Bitcoin. But is there a position for Bitcoin in your portfolio in any case? In this video, I'm going to use fundamental ideas of finance and economics to bring out the value proposition of Bitcoin. And what we'll see is that Bitcoin competes with gold for a position in your portfolio. Now, most investors are not going to want to own either gold or Bitcoin directly in their portfolio, but those who do should preference gold over Bitcoin. Now, there will be a few investors who will preference Bitcoin over gold quite rationally, and we'll see why that's true in the video. Now, we're going to start off by thinking about where Bitcoin should be positioned in your portfolio, if anywhere. Should it be in financial assets, meaning shares, real estate, bonds, private assets? And by private assets, I mean infrastructure, private equity, venture capital, real assets like farmland, private credit, etc. If you don't know what private assets are, then you should think about taking my investments course. Or should Bitcoin be in currencies? It's a cryptocurrency after all. Or should it be thought of as a collectible? We don't talk about collectibles very much because that's not a big asset class, but it's important in this context. Now, we're going to spend most of the video talking about the positioning of Bitcoin and its value proposition. But let's just start off with talking about the Bitcoin timeline and how Bitcoin got started in 2009. And an important event was the opening of the first futures market in Bitcoin. Back to that in just a moment. And then we had the opening of exchange-traded fund markets. First of all in Canada, then Australia, and especially in 2024 in the United States, these large, liquid, well-regulated ETFs, which have made such a big difference in the ease with which ordinary investors can invest in Bitcoin. Because up until the opening of these exchange-traded funds, investors had to use wallets and exchanges, which were complex, dodgy, poorly regulated markets. Now we have exchange-traded funds on well-regulated liquid markets, and especially here in the United States. Now let's have a look at the price of Bitcoin, 52,000 at the moment, and it's been surging with the tech surge. But I just want to point out what happened here because it's an interesting lesson in what happens to markets when negative sentiment can be expressed. So there was a surge in the price of Bitcoin in December 2017, where it surged to $20,000 or just about $20,000. And then the futures market opened up. And this is an example of a bubble, or here a mini bubble, being burst by a channel for negative sentiment being opened up. So before the futures market came along in Bitcoin, it was very difficult for investors who thought that Bitcoin was overpriced to express their bearish sentiment, to bring their negative information into the market. Anyone who was bullish about Bitcoin could always buy into Bitcoin. So the channel for bullish information was always open, but the channel for bearish information, for bearish sentiment, people who thought that the market was overpriced, that Bitcoin was overpriced, was closed. It was very difficult to borrow Bitcoin and sell it into the market, that is to short sell it. But with the opening of the futures market, professional investors could now take a short position in futures contracts and could express their negative sentiment if that's what they had. And that opened up the channel for negative sentiment and it burst that mini bubble. Now, we've seen that happen over and over in many different situations where a bubble occurs because only the channel for positive information is open. And then suddenly the channel for negative information opens and then a bubble gets burst. And that happened in a mini version in Bitcoin in December 2017. Now let's have a look at the relationship between tech shares and Bitcoin. We can see that here. Here we've got the NASDAQ market, the NASDAQ index on the NASDAQ 100, the 100 largest shares on the NASDAQ market in New York, a market that has most of the tech shares on it, like NVIDIA and Tesla, and Apple and Walmart, not Walmart, Amazon, etc. The Walmart's on the New York Stock Exchange, but the tech shares like Google and Microsoft, etc., are on NASDAQ. So this is the tech exchange. And here we've got Bitcoin. This red line is actually 3 times the NASDAQ to bring the two lines close to each other. And we can see that in the pandemic, after huge amounts of liquidity were pumped into the markets by central banks through quantitative easing and other measures, there was a surge in risky asset prices of all kinds. And there was also, and there was especially a tech surge. for a variety of reasons. NASDAQ surged up, and here we saw Bitcoin surged up, and this surge was largely caused by institutional investors bringing their money to the Bitcoin market, thinking the Bitcoin was a new asset class. But then after that, we've seen a strong correlation between Bitcoin and NASDAQ. Look at how they peak together. Look at how they head down here together, up and down, up and down. There's a couple of episodes where they move in opposite directions, but for the most part, this is highly correlated. Now you might say, well, Sam, why don't you present the correlation numbers rather than just looking at graphs here? But I think this is more useful in this context. Highly correlated. Bitcoin is acting like a volatile version of the tech index. Let's have a look at the ETFs. So these are the US ETFs that have been available since January of 2024. Before that, there was a Canadian ETF. There's one Aussie ETF, which has only got a tiny amount of money. Investors are going to, from around the world, are going to want to trade in New York on the ETFs that are listed there. And here we can see some really large ETFs. In such a short period of time, huge amounts of money have flowed in here. Plenty of liquidity in this well-regulated market. And if we have a look at the biggest one here and also the only Aussie one, the Grayscale Bitcoin Trust, 21 billion US dollars. These are very high fees, 1.5% per year in management fees. This won't last. Those fees will be down to single digits or close to single digits before you know it, just by competition between these different ETFs. And in the end, there'll probably only be 3 very large ETFs that'll have all of the liquidity. Maybe 1 or 2 specialized ones. But you can see here, if you buy an ETF, if you buy a share in this ETF, you're buying one part in 1,110 of a Bitcoin for your $46.19. But this is very accessible for ordinary investors. So now we want to go back to thinking about where Bitcoin should be positioned in your portfolio. Should it be in the financial assets, in currencies, in collectibles? And here we are with the financial assets. Well, Bitcoin doesn't go in here because Bitcoin doesn't deliver any cash. It's cash delivered by these financial assets that determines their value. What they embody is future cash flows. When you buy shares or real estate or bonds or private assets, you're buying future cash flows. Dividends here with shares, rents here with real estate, coupons, interest here with bonds, and across all the private assets, different cash flows. Now, Bitcoin doesn't deliver cash, so it's not in this category. Financial assets, the value of financial assets is driven by the quantity and the quality of cash flows that they deliver over time. The willingness to pay of investors for financial assets like shares and bonds and real estate and private assets is determined by the amount of cash that they'll deliver in future years and the quality of those cash flows. The quantity and the quality of the cash flows, where the quality is determined principally by the riskiness of the cash flows and the liquidity of those cash flows. Quantity and quality determines the willingness to pay of investors and therefore the price of those assets. So that's not Bitcoin. Bitcoin's down here in currencies. Of course it is, you might say. It's a cryptocurrency. Well, it's not that obvious. It could be down here in collectibles, which will appear in just a bit. Now, when we talk about currencies, we're going to be thinking particularly about gold, the US dollar. You could think of other currencies like yen or euro or renminbi or Canadian dollars or Aussie dollars instead of US dollars, but gold and US dollars relative to Bitcoin. Should investors have Bitcoin instead of one of these currencies in their portfolio? Now, we're thinking principally here about value creation and how does money or currencies create value? Well, it does it by being a means of exchange, meaning a means of payment. It does it by being a store of value and a unit of account, but we're not going to worry about unit of account here. We're going to concern ourselves with means of exchange and store of value, starting off with means of exchange. So how currencies create value by being a means of exchange? Let's just use this simple framework. Let's think about a world in which there is no currency to use for payments, and it's a barter economy. And then we're going to introduce currency and we'll see how much value is created. I know this is simple, but don't worry, believe me, it'll lead to much deeper ideas. So let's imagine you have fish, but you want bananas. And by bananas, I mean bananas. And so you need to find someone who wants fish, and that same person has bananas. So you need the coincidence of wants. that they want fish and that they have bananas. Now, that's a very constrained problem, and it'll be hard to find someone like. But once you introduce money into the situation and move away from a barter economy, then you've got a lot more degrees of freedom. So all we need now is to find anyone who wants fish and will give you the money, and then anyone who has bananas and will give you the bananas. And as I said, a lot more degrees of freedom. And so, this unblocks a lot of transactions and creates an immense amount of value in doing that. Now, that just means that payment solutions in general create a huge amount of value in the economy. But do we need Bitcoin in the specific, or Bitcoin in particular? Bitcoin, to create value now, has to do something that the current payment systems don't. And the current payment systems are very efficient, safe, and fast. And Bitcoin, as a payment system, as a means of exchange, is not very good. It's got a high latency, which means it takes a long time for the transaction to go all the way through to completely clear. And it's not as anonymous as it was originally thought it would be. So it was originally thought that Bitcoin would be this fantastic payment system for the digital economy, but that hasn't played out at all. That's not it. So, currencies as a means of exchange create a vast amount of value in the economy. And that's been true since really the dawn of finance. It was the very first part of the financial system, was having a payments mechanism. But Bitcoin hasn't really contributed to that at all. So we need to move on to the next part, which is the store of value, to see if Bitcoin can add value. So currencies as a store of value. Let's go back to our example here and go a bit deeper. So you created value by catching fish, and then you turn that value into money by selling the fish to somebody else. Now you want to carry that value in the form of money into the future. Now you could carry it into the future by investing the money into a financial asset, like shares or bonds or property, real assets, etc., private assets, etc. But you don't want to do that. You don't want to take that risk or have that illiquidity. You want to have low risk, liquid asset. And so you're going to do that with a currency, and the currency has to be scarce, has to be verifiable, and has to be durable. That's the properties of a currency that can carry value into the future. Now, gold meets all of those requirements. It's scarce. Most of the gold we'll ever mine probably has been mined already. It's verifiable because it's an element. It's highly durable because it doesn't react with other elements. It's chemically inert. And it's relatively stable in price. It's fairly volatile, but it's relatively stable in price. So 4 ticks. Now, what about Bitcoin? Well, it's scarce because there'll only be 21.6 million Bitcoins ever. It's certainly verifiable because of the blockchain, the distributed ledger. It's durable, but is it stable? Well, we've already seen that it's not stable. It's about 3 times more volatile than the NASDAQ 100 index. That's what we were looking at earlier on. Now, going on, creating of a store of value. Well, how do you create a store of value? And here we're going to get into creating US dollars, which is going to be really important for us because we want to start talking about inflation and protection against inflation. Well, gold is terrific. It's not easy to create new gold. And that's important for its scarcity and for it to maintain its value. So mining gold is not easy. Creating new Bitcoins by mining is not easy, and there'll only ever be 21.6 million, as we said before. What about creating US dollars? Well, you could conceivably create your own US dollars. You could counterfeit them. Now, that's not technically easy, but there's actually a much bigger problem with creating your own US dollars. You're going to have to face that. Even North Korea, which is essentially an outlaw country and can create its own nuclear weapons, won't counterfeit US dollars. The US is so protective of its currency. Now, this is going to be important for us going forward here in thinking about this and about whether the US will insist on protecting its currency by getting rid of digital currencies. And I really want to emphasize how protective the US is of its currency here. But we also want to think about the US creating more of its own currency and potentially generating inflation by doing that. So let's look at that. You can't create new US dollars, but the US Fed can certainly do that. And here we can see total US dollars in circulation. Less than 700 billion in 2002, 20 years later, over $2.3 trillion. And we can see that most of them are $100 bills. That's this. Most of that 2.3 trillion, nearly 2 trillion of it, is $100 bills. It's all about the Benjamins, as they say. And that makes a lot of money for the US government through the Treasury. So there's about $1 trillion in circulation in 2011, and 11 years later, 2.3 trillion. So that means that 1.2 trillion has essentially been created out of thin air. 120 billion a year of value, which goes to the US federal government, has been created per year. Now that's referred to as seigniorage. Now you might know that a seigniorage is a feudal due. So it's an interesting term to use here. But that seigniorage is value that goes to the US government and to any creator of their own currency by creating $100 bills out of sheets of plastic. Now, they're not going to give that up easily. They're not going to let anyone challenge that easily. We need to be absolutely clear on that. Now, we want to turn to monetary policy. Now, this is another reason that the US government and any government is absolutely determined to protect its currency, because controlling the volume of money controls the speed of the economy. That's what monetary policy is. Fiscal policy is government spending, but monetary policy, the other big economic lever that the central government has through the central bank, is by changing interest rates to speed up or slow down the economy by changing the volume of money. And that control mechanism over the economy, the government's not going to let anyone mess with that. Let's just remind ourselves of how that works. We can see it in our example. Monetary policy, set the volume of money, control interest rates, control the speed of the economy, okay? So you sold your fish, now you've got money, you want to carry it into the future, and so you're going to turn your $1 today into $1 plus interest by putting it into the bank. So you're going to carry it forward, not in Bitcoin or in gold, they don't pay interest, but if you carry it forward in US dollars, it'll be in the bank and you'll earn this interest rate R. Now, the volume of money, which is controlled by the Fed, will determine the price of money. The supply of money will determine the price of money, which is this interest rate. And the interest rate will determine the level of economic activity. That's because this interest rate is really an exchange rate between the present and the future. That's what interest rates always are, an exchange rate between the present and the future. I can have consumption today, or I can have consumption in the future. If I don't want to consume today, I save my money and then I consume it in the future, but I get more. And here's the exchange rate. And if we change that exchange rate, we change people's decisions. So if the interest rate goes up, that means that fewer people will consume today and they'll save to consume in the future. And because there's less consumption today, raising the interest rate is going to slow down the economy today. That's the mechanism. Well, it's part of the monetary mechanism. There's other channels through which monetary policy acts, of course. But this is really crucial. And the federal government's never going to give that up. And they'll protect it against anyone. Now, as an example of this, Facebook introduced Libra. So it introduced it in 2019, in June of 2019. They announced Libra, which was going to be a digital currency, which would be used across the Facebook platform and all of Meta's, then Facebook's platforms. And you would be able to exchange between members of Facebook's platform a digital currency controlled by Facebook. But the Fed and the US Treasury acted against it immediately. And then it never went ahead. By July of 2019, Facebook was saying, Mark Zuckerberg was saying, before the US Congress, we'd been called to testify, he was saying, we don't do anything without the explicit permission of the Fed and the Treasury. And the Fed and the Treasury shut it down. They thought that Libra would threaten their control of US currency. Now, they never acted against Bitcoin. Why not? Because they're not worried about Bitcoin. The Fed and the Treasury don't think Bitcoin will ever amount to anything. But Libra, they really thought that could be a huge amount of transactions, a lot of economic activity that they didn't control happening between members on Facebook, and an increase in the effective volume of money that they didn't control, and the loss of control of monetary policy. That's what they thought about Libra, and they acted against it immediately, and really immediately. The same day that it was announced, they acted. They announced their opposition to it. Now, they've never done that to Bitcoin because they don't think Bitcoin amounts to anything. they think Bitcoin goes away eventually. We don't know if they're right or they're wrong, but they're definitely not worried about Bitcoin. But if they did become worried about Bitcoin, they would act against it. And that's a problem for Bitcoin. That means that if Bitcoin becomes very successful as a successful and used part of the economy, then the likelihood that there'll be regulation in the US against Bitcoin is very high. And it puts a cap on the success and the usefulness of Bitcoin. Now, just going back to the store of value here and thinking about increasing the volume of US dollars, there's a fair chance that the US has to print money because of the increase in the volume of US government debt. I shouldn't say there's a fair chance, but through time, there will be a big incentive for the Fed to want to inflate away US debt. The US is ultimately heading to a debt crisis. It's already true. The US federal government debt amounts to over 100% of GDP, and it'll be over 200% by 2050. So we are heading into a major debt crisis in the US. And one way of getting out of that crisis is to inflate the debt away. And people think about that and they think, well, why don't I have some of my wealth in gold, which can't increase in supply? So if US dollars increase in supply, but gold remains fixed in supply, then the value of gold will go up. If US dollars goes up in supply to try and inflate away the debt, but Bitcoin remains fixed in supply, ultimately only 21.6 million Bitcoins, then don't I want to be in gold or in Bitcoin to counter that possibility of value being inflated away? Now, you might quite naturally say, well, if I want a hedge against inflation, inflation, not hyperinflation, but inflation, where inflation goes into the teens or something like that, like happened in the 1970s, then why don't I just invest in property or in shares? Won't that give me a reasonable hedge against those kinds of relatively mild levels of inflation, not hyperinflation? Well, yeah, I think that's absolutely right. And the need for gold or for Bitcoin in your portfolio to hedge against inflation is really a hedge against hyperinflation, very high levels of inflation. And the likelihood of that happening in the United States, I think, is so small that there isn't really a need for gold or Bitcoin in most investors' portfolios to hedge against that risk. But that's what people have got in mind. They got in the back of their mind that I need this hedge against the possibility that very high levels of inflation come along. Gold and Bitcoins are competing hedges against inflation because of the danger that the Fed inflates away US debt. Now let's have a look at Bitcoin and gold. Let's stack them up. So inflation hedge, well, they can both work as an hedge against hyperinflation. They're easily traded, absolutely. They're stable in price. Well, Bitcoin's not at all stable. It's got 3 times the volatility of the NASDAQ 100. Gold is not especially stable either, but it's a lot more stable than Bitcoin is. Now we finally get to our cross here. Regulatory risk. Bitcoin faces really significant regulatory risk. The danger that the US government will act against it at some stage because they think that it threatens control of the currency. And look, I mean, when you think about how could they act against it, the US government could ban any US organization, any US company or financial institution, or any US individual, any US citizen, from owning or transacting in Bitcoin. They could do that. That would be a dramatic action, but they definitely could do it. And that's never going to happen to gold, which has been around since really the dawn of civilization. Now, what about the tech risk? Well, we haven't really talked about this, but the tech risk with Bitcoin is that something new and shiny comes along that's not Bitcoin. A better solution, a better technical solution to the problems that Bitcoin is trying to solve. And because Bitcoin sort of has as its origin and as its appeal, its unique technology that goes with it, it's sort of inevitable, isn't it, that some technology will come along and will displace Bitcoin at some stage. Now you might think, well, Bitcoin will just become so entrenched in the financial culture that it'll never be displaced. But look, I'm not so convinced about that at all. So there's a lot stacked up against Bitcoin. And you can see why I say that if an investor is going to choose to have inflation or Bitcoin, gold or Bitcoin to help it to hedge against inflation, then it should choose gold. It should preference gold over Bitcoin because of these problems associated with Bitcoin that are not associated with gold. I don't think investors need to have direct ownership of either gold or Bitcoin. in their portfolios. But if they feel they do need that for a hedge against really extreme circumstances, and especially very high levels of inflation, then they should go with gold. Now, just before we go on, I should remind you about my Finance Education for Investors course, which is coming up. So it's over 10 Thursday evenings, starting on the 2nd of May. You can attend the live classes and or watch the whole thing on demand. So it is the live classes, 10 2-hour live classes, but you can also watch it on our learning management system, which is, we use Thinkific for that purpose, a set of videos, and there are supplementary videos as well. There's lots of other materials. There's the notes, the case studies. We have a limited number of participants. It's $1,200 plus GST. Well over 2,000 people have taken the course and had a great experience with it. So go to whittlestone.com.au to enroll in the course or for more information. Coming back to our portfolio, where Bitcoin is positioned in the portfolio, it's not in the financial assets because it doesn't deliver cash, but it can be down here in currencies if we're worried about inflation, not garden variety inflation, but really high levels of inflation. Bitcoin or gold could be a hedge against that. But if you are concerned about those high levels of inflation, holding Bitcoin and gold directly, then preference gold because it's better in almost every way. That's where we got to. And now we want to think about collectibles, which are parts of a portfolio that are held for appreciation, for capital gain, but deliver some utility. Don't deliver cash, but deliver some utility, some benefit of ownership. And there's plenty of examples of that, of course. There is fine art, such as these examples. There is fine automobiles, such as all of these. And there's an element of that in Bitcoin. And we can see it in terms of the finance culture and in lottery type payoffs. Now, I didn't really know about this notion of the finance counterculture until I started talking to a few Bitcoin bros and a few Bitcoin sisters in getting ready to make this video. And then it came out that part of the reason people like to hold Bitcoin is to feel like they're part of the finance counterculture, something that is sort of cutting edge and different. And as I said, counterculture. And that's a benefit to them for the holding of the asset. It's like a collectible in that sense, a benefit that accrues to you while you're waiting for the value of the asset to go up. So that's why I put it in collectibles. I know it seems a little bit curious, but it has that same property. Then there is also the lottery type payoffs of Bitcoin. The feeling that I have some Bitcoin in my drawer, X thousand dollars of Bitcoin in my drawer, and it could go up 10x or 100x. Maybe 100x is just a dream, but you know, the lottery is just a dream. And people pay for lottery tickets, and you pay for Bitcoin in the sense that you're not receiving any income while you're holding it, but you're receiving this benefit of having the feeling that it could go 10x, it could go 100x. So, you know, not a cash benefit while you're waiting for the capital gain, but another benefit. And that's why I put it in the category of being like a collectible. So finance counterculture, lottery type payoffs. Now we get back to our list, comparing the properties of Bitcoin to gold, and we see that gold is better in so many ways. It's more financially stable. There's much lower regulatory risk that the government, especially the US government, will act against it. That'll be displaced by technology. That's impossible in the case of gold. But there is this utility of ownership. And if that's large enough, then Bitcoin should be preferenced over gold. Now, for most investors, they're not going to hold either gold or Bitcoin directly. They're just not that worried about inflation or about the stability of the financial system. So it's not going to be either. But for people who are going to hold one or the other, most are going to want to preference gold. But some, if this utility, this counterculture and the lottery type property is sufficiently large, they'll want to preference Bitcoin. So there is a component of rational ownership of Bitcoin in portfolios, which is separate to the game of trying to ride a bubble up before the bubble bursts. And there's plenty of that going on. You know, I do wonder about the long-term demand for Bitcoin. If this is driven by fashion, fashions come and go. And you know, that's not about gold. I mean, gold is embedded in the culture, in religion and culture all the way around the world. And there's and there's just a bedrock demand for gold that is totally enduring. And whether the bedrock demand for gold, for Bitcoin, is sufficiently enduring, whether that even exists, that fashionable component to the ownership of Bitcoin in 30 years' time, I think is deeply questionable. Now, there's certainly people who own Bitcoin because they feel like they can ride the bubble up. They feel like it's a bubble, but they feel like they can benefit from the bubble and jump out before the bubble bursts. That's a big component of ownership of Bitcoin. That most certainly is not what we are talking about here. What we've been talking about here is rational ownership of Bitcoin in portfolios. So the cost of and the difficulty of normal and ordinary investors buying Bitcoin has gone down dramatically because of the access to well-regulated and highly liquid large ETFs on the US exchanges. And investors around the world are going to invest in Bitcoin through those exchanges going forward. It's so much easier now. But is there a place for Bitcoin in your portfolio? Well, not with your financial assets, the stocks and bonds and real estate, because it doesn't generate cash. In the currencies, well, only if you feel like holding gold or Bitcoin directly is something necessary for you. And that would especially be true if you're worried about inflation because of the debasing of US currency, the printing of too much money. I'm not worried about that. Personally, not sufficiently worried to hold Bitcoin or gold directly, and most investors are not. But if you do, preference gold for the reasons that we've been talking about. There's a small number of people for whom it's rational to hold Bitcoin over gold because of the extra utility they get from from holding the Bitcoin itself, from the finance counterculture component, and from the lottery-like properties. So I hope this has really helped you to understand Bitcoin at a deeper level, and that you'll watch the rest of the videos in this series, that you will like and subscribe, and that you will remember about my course, which is starting on the 2nd of May. See you in the next video.